Thanks. Good afternoon, everyone. Thanks for attending this post-lunch discussion. As mentioned, my name is Warren Boltler. I'm CEO of Price Forbes in South Africa. We're a niche provider of risk advisory insurance services in the mining sector globally and throughout Africa. The panel discussion is entitled Sources and Structures for Financing a Mine Through to Production. It's sort of vaguely what we're going to stick to. We're going to concentrate on that to an extent, but I must say that some of the financing issues that we're going to unpack a little bit will span the pre-production construction site and into the long-term funding positions as well. I think the panel's already been introduced. I'm not going to go through it again. We've had the names already. What I'm going to try and do today a little bit is just break down a couple of the key financing issues and challenges for predominantly our clients, who miners and junior miners, explorers, operational miners, and just try and unpack them a little bit so that firstly I can understand them and secondly you can understand them even better. I'll try and deal with three headline topics. The first one is risk appetite, or the changing risk appetite, investment appetite, the differences in the types of funding available, and also a couple of risk issues at the end of the day. So touching on investment appetite, and I'm going to ask Paul to start from Nedbank. In the year that has passed since the previous one-to-one, the previous mining in Durban, has investment and risk appetite changed on the part of investors, particularly from your local banking perspective in South Africa, for investment projects in mining in South Africa and Africa in general, for starters?
Well, to be clear, Nedbank's a traditional bank. We provide senior debt financing to projects, which means that it's not really a question of what our risk appetite is. Our risk appetite is pretty constant. It's how many projects have reached bankable feasibility stage, or how many projects can reach bankable feasibility stage. Can they raise their equity, and is the price right for their commodity? So the investment appetite from us as a bank, I would say, has been unchanged through the cycle, and in part that's because our mining finance team at Nedbank has been either skilled enough or lucky enough not to have lost any money for our bosses, and as a consequence our mandate has remained constant. It is fair to say, though, that we haven't seen the amount of pure project limited recourse project financing as we would have liked to have over the last 3 or 4 years. So it's only, in fact, in 2016 we didn't do a single pure limited recourse project financing. We did a lot of refinancing of existing clients. We're starting to see that pipeline picking up now, which I attribute to the equity having been spent on the studies in the 18 months or so but ahead of that. And if that's evidence of anything, that's evidence that equity investors are starting to put money into projects, and we then lag that and start seeing that coming through on our pipeline now. In South Africa, unfortunately, it's not, from a pure project financing point of view, it's not as rosy a picture as the rest of the continent. We completely mired in our own problems here from a regulatory and political point of view. We haven't seen projects started coming through here yet. Our pipeline's been filled from a pure project finance point of view with the rest of the continent. Thanks,
Paul. With respect to foreign investment appetite, Jan, say from the Australian point of view, can you just answer the same question? Has your appetite and availability of funds increased or decreased since you last sat here?
Our position hasn't really changed. I think the points that Paul made would apply to FX as well. In that regard, we don't turn the taps on or off according to the credit cycle. And in that sense, being an export credit agency, we are more reactive to the Australian involvement in any project that we may look at. So to the extent there is a project where there is Australian involvement that would provide us with Australian content, which is one of our key eligibility criteria, and subject to the project economics stacking up, then that's something we would certainly look at.
Okay, and finally, same question.
Sorry, with regard to South Africa, just on that last point. Again, we have appetite for South Africa. Until last year, we were looking at a project in South Africa together with Paul. Those discussions terminated not because of any political risk perceptions or issues that arose. It was more a commercial discussion. But otherwise, had that gone ahead, we would have been financing that project.
Sean, from a Canadian perspective, is the sentiment the same?
I think compared to many on this stage, my business has been going for 20 months, 21 months. So we've been looking to put money to work. We've looked far and wide. So we're looking at a number of opportunities in Africa. We've invested in the last year a little over 100 million in development stage projects, and one of them is Mongolia. So I think from a country risk perspective, as long as we can understand the jurisdiction, we can manage the risk appropriately. We like the team, we like the ore bodies. It's standard stuff, and we're willing to assess an opportunity on its merits. So yeah, there's money there if people have got good opportunities.
Okay. With all the talk of equity finance having dried up over the last 5 years or so, how's the system for finding equity change over the last couple of years? David, can I ask you to talk about that?
Sure. I'm very familiar with that aspect. We're a public company ourselves, subject to influences and things that affect the equity markets. But we are also, in the nature of our type of investments as streams, needs us to rely on partners that can effectively reach into capital markets during their entire life cycle. So we spend a lot of time thinking about that. The nature of a stream and royalty type of finance is in some ways, it's the ultimate long-term investor. So you're spending a lot of time thinking about how your partner is going to get financed, not just to get the mine built, but to get it further. So, and to operate, because mines always need capital throughout their entire lives. So, but what has changed in the last several years is almost a very broad structural change in how that high-risk equity capital gets into the markets. First of all, there's been a huge inflow, just in the last 4 years, from managed equity into passive equity in the form of ETFs. And that's had a huge effect. Sandstorm is a $1 billion US market cap mining company with about $50 to $60 million in cash flow per year. But 30% of our shareholders are just passive equity. It's just ETFs. So what that tells me, as a larger company, is that if I have to go out and get equity itself, before I used to go to actively managed, many of them were gold-focused or mining-focused resource funds, but that just is not, that's not happening anymore. Those funds barely exist. They barely have capital available to them. And my largest shareholders, as it is with every other medium-sized or large-sized company, is going to be 30% passive, which means you can't rely on them upping their investment into the company. It's gotten even worse for the smaller companies, because what we've seen, I think in almost every jurisdiction, but it's been very pronounced in Canada, is that the ability to reach that speculative risk investor has diminished enormously. I know one independent broker in Canada itself, very large one. Since 2013, it has dropped the amount. It has 22% of the brokers that it used to, just 5 years ago. And also, much of that money, because of overregulation, has just kind of flown into that passive funds. Brokers have become wealth managers, which are selling funds instead of individual equities. Regulations have caused many of those independent brokers, because the cost is too high to maintain compliance, they're just having to fold. So we're seeing a real lack of that equity, and for junior partners and exploration groups, that can be devastating, because you just can't find that equity capital. And it's not a matter of just having a lull in the commodities or a lull in the gold space. It's more of a structural change where those investors, that retail investors that were looking for that speculative risk capital, just don't even have a mechanism for them to go and put their money into these companies anymore.
Thanks, Dave. Just touching back on the sort of the risk parameter or the appetite parameters we spoke about a bit earlier. It's the benefit of the miners out there. What type of operation or resource specifically is most attractive to you guys at this point in time? What sort of flavor of the month? And maybe, Jan, you can start by telling us what particular resources are of interest to you on the African continent and generally worldwide as well.
Well, I think across the board, wherever in the world, we like commodities that have a terminal market for obvious reasons. Having said that, we are being presented with opportunities in sort of more, if I can call them exotic or industrial minerals. and where the commercial aspects of the project become key in terms of offtake counterparties and the strength of the offtake agreements.
Paul, in your view?
So it's very similar for us. We commodity agnostic. We don't take a view of what's the flavor of the month. If there's a good management team, a very high standard study, and we can see, or the management team can present to us, how the major risks to the predictability of the cash flows are being managed. And what we don't do is, as a bank, we believe we are a credit providing bank. We lend money. That's our primary business. To the extent that we have to hedge risk, that's a secondary business for us. And it's explicitly to limit the risk to the predictability of the cash flows. It's not about leading with a hedging business or a commodity hedging business and then following with debt. For us, it's very much the reverse. We lead with our balance sheet and we look to hedge those. And we'll also look to the extent with things like industrial minerals, and we have lent to, for example, mineral sands projects. We will look to the natural hedge inherent in the business from its position on the cash curve, on the cost curve. So as long as those major identifiable risks are clearly mitigated, we're not concerned particularly about what type of mitigation that is. We don't have a view on that.
Okay. Nick, can we ask you, let me frame a different question so we change the topic. In many of our conversations with our mining clients, the concept of the expense attached to feasibility studies always comes up. What is the appetite for debt funders, in particular, to fund the feasibility studies? And what's the best sort of structure to do so?
Look, Warren, it's typically out of equity. As the guys have said, you want to get to a stage when you're looking at senior debt, senior secured debt of a BFS which stacks up, which has got solid independent studies and is pulled together and shows a strong economic project. And you do your debt sizing, and if you need hedging, we don't require hedging at Taurus, but if you need hedging, well then we're happy to do an intercreditor arrangement, and the borrower can hedge and risk mitigate. As I said, we don't require it. Sometimes that can be an advantage in that management and boards sometimes want to have their shareholders open to a rising commodity price. Just to touch on some of the things that the guys have spoken about in your earlier questions, Warren, part of our business is not just trying to seek the returns that we promise our LPs, which are typically US institutions, private and public pension funds that trust us with their money. It's also about the ability to deploy those funds. And so, talking about the appetite and funds appearing and private equity type funds, as well as the banks, we're all trying to deploy our money as safely and as quickly as we can. In relation to that, there's a lot of competition, I believe. Talking about debt, there's a lot of debt funds that have sprung up, alternative type funds, and we're all trying to win business. And so part of our job is to position ourselves with whatever levers we've got by our mandate to be able to secure that business. And if that means that you provide a bridge funding as a company is completing a feasibility study, so be it. You just want to make sure it's not a bridge to nowhere. That's basically our criteria, and that if a company's 6-9 months out from completing a DFS, we look at obviously all of the technical parameters and the management parameters which are critical. If we can provide $10-20 million to get them down that path because they find that going to the equity markets is too dilutive, shareholders don't want that, then we're more than happy to do that, provided we've got that mandate to go into senior financing. And 10 years ago when I was working at Societe Generale, I had 4 years in Paris back in the 90s. I came back and was lucky enough to be able to get just a small allocation, $40 million US. We set up a thing we called a mining hybrid fund, and in the early 2000s we were lending $4 and $5 million to companies like Paladin, who had a minimal market capitalisation, Equinox, to complete DFSs. And part of the strategy was to put get your cab up the front of the rank to be able to do your core business, which was your senior financing. And that's the plan. If that means providing a bridge, we're more than happy to look at it, but you want to make sure it's not a bridge to nowhere, and you want to make sure that you have a firm meeting of the minds with the borrower as to what you're looking to do then on the senior financing to take the project into construction and commissioning.
Okay, so the DFS gives you the foot in the door, and hopefully you're sort of the first guy
That's the
there.
idea. And you're running in parallel with the company as they complete the studies. You know, if there's any concerns that you have in relation to people being used into beefing up operations in a timely way, well, then you're working together. You know, you're joined at the hip.
Okay. So just following that theme, how competitive out there is it for mining investors, both debt and equity? How do you compete? How do you work together? Is there enough out there for everyone to sit side by side?
Quickly,
or do you,
I mean, I agree with some of the comments that you know, there is a lot of regulatory issues. Permitting's become difficult in a lot of countries. But look, there's a lot of competition. Sometimes you are competing on terms. Other times you know, we all get to know each other. We all know our mandates. In the private equity landscape, we all have similar type return hurdles. And so you can join together, and sometimes if the debt size is big enough, you know, you can work together, and sometimes that's fantastic because you can, you know, share out the various work tasks, you know, technical, financial, legal, etc.
Okay. So just speaking on the working together, Jan, I'm going to ask you to tell us a little bit about the involvement of an ECA in the arrangement. How does it benefit, firstly, the co-investors, co-debt providers, secondly, the investees? I mean, what are the upsides of an export credit agency getting involved? Does it help the other guys?
Sure, Warren. Look, at the end of the day, it depends on the perception of the project proponent or sponsor and the other lenders. The key differentiating factor for an ECA as opposed to commercial lenders is that ECAs perhaps have appetite for country risk or exposures that commercial lenders wouldn't have without the benefit of, say, PRI. And a further factor that where ECAs differentiate themselves is that depending on the project and the project economics and the commodity, ECAs have the ability to provide longer tenor financing. So typically for base metals, that can be quite an attractive economic driver. Some commercial lenders derive comfort from having an agency financing alongside them, as do investors. And then in terms of working with banks, not only can some ECAs, and I speak on behalf of EFIC, we can provide both direct funding as well as provide what's called ECA cover, and in our case that's a guarantee, and our obligations are guaranteed by the Australian federal government, so that if we provide a guarantee to a commercial bank or commercial lender, not only banks, it could be a private equity fund, that guarantee is essentially a AAA credit rating, so that should be quite attractive to some people. And so we talk about the halo effect. If we're involved in a project and there is a political issue with that particular project, the first person that we will call would be the Australian ambassador, and hopefully through those kind of representations, everybody can derive some kind of benefit from it, either explicit or implicit.
So let's say, I mean, two different types of funding. It's like a streaming arrangement, for example. Would the presence of an ECA on the syndicate, whether it's a guarantee or side-by-side debt participation, make it a lot easier for you to get to close? If you can, yeah, sure.
You know, I think a couple of themes that comment on. One is just this point around competition. I think at times people look at it in too binary a way. You know, in the last 13 months, we've committed over $500 million in opportunities, and that represents like 2% of the deal flow we've seen. And a lot of that we didn't want, but a lot of it we did. And you know, if you look at the deal we closed in December on Nevada Copper, you know, there's a lot of dogma, I think, in the sector. People are still using an old lens or old paradigm of capital and debt as being the sort of conventional way, which isn't always that easy to get. And so, you know, we were successful in working with Parla, for example, on helping to recapitalize some very expensive debt, restructure that. We came in as cornerstone equity investors along with Parla. That enabled them to raise $100 million of equity on a $370 million recap, and we put a $70 million stream as part of that and a $10 million equity check. And the equity traded up 60% within a very short period of time. So very often people think, you know, you put these instruments in place and it's bad. The reality is each of us at different times have different skill sets, different risk appetites, and it's about having the right capital structure for the stage that you're in, and also the skill sets to assess that risk and to be able to put your money to work.
Okay.
Perhaps if I could make a comment.
Yeah.
As a regional African bank with a focus on Africa, we obviously work often with export credit agencies and with development financing institutions. So we're very used to working with them, and we've worked alongside Taurus on a number of and other private equity funds. I have to say, though, the one where we don't have a precedent yet is to work alongside a stream. As a traditional senior secured lender, we haven't done that yet. It's not to say it can't be done, but I'm looking forward to the first one.
No, it certainly can. I mean, I've been doing now the streaming and royalty space since 2004, and it is less familiar. Like, despite the fact that it has been around for almost 18 years now, that this type of, especially for the development of construction of an asset, it still is relatively unknown, especially in Africa, especially with Australian groups as well too. But we have been successfully been able to work with lots of different debt financing, either private equity type of funds or with actual bank project financing. And it's something that I think we all are forced to do, because this whole traditional just equity and debt market is much different. Like what I was saying before, those equity markets to a certain degree are broken. Much of that equity that traditionally would just come straight in through brokers, through funds, is going more through the private equity groups. They've been much more successful at attracting that institutional money into it rather than mining companies themselves. So you really do have to create a proper capital structure. It's much more complex, and it needs to be a much more cooperative type of effort going forward for anybody, for any operators, and from the junior side all the way up to the senior companies to be successful.
Thanks, David. I think leads us very nicely into, I'm going to ask you to do your 1-minute pitch, and maybe we'll split this up into two between Sean and David. Many different methods of investing in mining. You've got traditional equity, private equity, listed equity, long-term debt, mezzanine. You've got all kinds of methods. We've spoken about streaming and royalties, but you guys each represent streaming and royalty operations. Maybe you do your elevator pitch just for us. Tell us in 1 minute what streaming is, how it's different to traditional forms of investing in mining, and then maybe you can catch the royalty, do the royalty one for us.
To a certain extent, streaming is a little bit more like a substitute for equity or pseudo type of equity. What we do is, in exchange for the upfront payment, we're getting a percentage of the future production in either a specific commodity or a whole range of the commodities. It ends up being quite effective because we're a passive investor. It allows you to really operate the project you want it to do as long as it passes our due diligence. We tend to be very quick. You know, we're able to execute on some deals within a matter of weeks, so we're able to really kind of get to that finish line almost immediately and take point of view. Being a public company, it's taken a while for us to build up the ability to really kind of have that portfolio effect so that we can take, I think, much larger risks in the type of investments we have. As a result, we've been not just doing cash flowing deals or development deals, we've been reaching down into exploration companies as well too, financing them through equity and through royalty type of transactions, which tends to be kind of that forgotten sector of the groups that we're working with.
So streaming, you effectively secure yourself a share of the produce that comes out of the operation.
We'll end up securing a percentage of it, but we end up being a very favorable partner in that. You take a look at something like the Karma project that True Gold had put together. A nice economics, instead of being financed traditionally through equity and capital, it did equity and stream. Between ourselves and in Franco-Nevada, we did a syndicated $125 million deal. About a third of the way into production, they had a bunch of community issues. They had, if you remember, they had their leach pads had been burnt up. It was essentially caused an 8-month delay in the whole project. But for both Franco and ourselves, it wasn't a big deal. There wasn't a big pressing issue to get that production on a specific date. The NAV was still preserved on the project, and so we ended up being that ideal partner for them in them being a single asset in construction, because we were not fussed about any kind of delays. It didn't cost them any more than the cost of capital didn't go up for them. They just had a delay. Their share price obviously went down, but it went back up again, and then it was successfully purchased by Endeavour a few months later.
Okay. Sean, briefly tell us what royalties are.
Yeah, it's kind of ironic. You know, in the more than $500 million we've put to work, there haven't been any royalties involved in that. It's been streams, equity, and some offtake.
Okay.
And it's not for lack of looking at those. I think like the transaction with Parla, one of the challenges was there was an existing royalty on there, which I think was given away cheap early on. And you know, it's great if you're the holder of that, but I think all of us hopefully are investing in things and looking for long-term partnerships, which frankly work for the mining company as well as the financier. You don't want a distressed situation down the road, and you want to make sure that the asset, whether it's debt or it's a stream or a royalty, frankly has the cash flows, even under weak market conditions, to work. So we spend a lot of time looking at that and trying to find the right type of partnerships. And I guess as a former CFO, you realize there's different times where your equity very often is given away too cheap. And I think people incur dilution far too easy. I said, you know, equity very often is given away far too cheap. And I think trying to find those alternatives without betting the farm, if you've taken on too much gearing, is really important. And if it's early stage, maybe a good cornerstone equity investor with a royalty, like David mentioned, can work. I think other times when you're actually at the point where hopefully you've got a path to credible cash flow, and I think David, 1 in 5 actually deliver on their promises on ramp up. So you've got to be prudent. You have to have some safety buffer.
Thanks. Right, let's talk risk for a minute. Nick, you've been around for a while. You've seen many investments. You've managed many investments. You've exhausted your equity fund. You've got sort of available debt. What can go wrong in some of the investments that have gone wrong? What are the key perils or triggers for them?
I see we've got 3 minutes. Everyone in
pick a few examples.
Everyone in this room is in the resources and the mining sector, so there's a million things that can go wrong. We've all touched on a couple of the things. Management is critical. You know, strong management, quality of studies. You know, there can be geological issues. Of course, there can be commissioning and metallurgical issues, there can be governmental issues and what have you. But one thing I would reiterate in relation to what a lot of us guys do up on the stage here, you want to try and find a patient lender, someone who'll work with you, work through the tough times and what have you. And quite frankly, as opposed, I did have 14 years at SocGen, and thank God we didn't have, in the Australian operations, we had one major catastrophe. It didn't cost us a lot of money. But you can quickly go in a banking situation when things do go pear-shaped into what's called the risk committee, the workout group, and all of a sudden you're not dealing with overly patient people. I think that the people who are representing alternative funding, we need to get our returns. If we want to keep the lights on in our place, we need to be able to raise our next fund. And to do that, you do not want to have major losses and major provisions because it'll obviously impact your performance. So we are very patient in that you work as hard as you can with a distressed situation. I mean, Base Resources is a classic example. I don't want to go into unique cases, but I say Base because Tim Carstens, we're an investor, equity side, not a lender. We actually provided some quasi debt equity to them when things went wrong. They commissioned their project fantastically. It was a wonderful job that they did in Kenya on their mineral sands project. Prices went against them. So what you need in those situations is patience. All of a sudden, prices come back. How quickly debt can be repaid in a strong cash flow environment. So you need patience. You need people who are sympathetic to issues that arise. It is critical in going into relationships that you pick good management, strong management, or if they don't have good management, you make sure you hopefully transition that they do have good management, because that's a critical thing. Okay,
so danger from all angles. Anyone else want to just add to that? I mean, what in your experience, anything that's gone wrong that's kind of got a recurring theme?
Perhaps I can make the point, as an African lender that's in some pretty interesting countries, we've lost money because projects have failed technically. We've never lost money because of political risk. And it just goes to where we place relative emphasis, right? And I would say you should be far more concerned about the technical success of your project than we tend to place the emphasis, at least, on the political risk on the project. Of course, you've got to mitigate it both, but we seem to focus all the time on the political risk in Africa, where you're far more likely to lose your money because the project failed just as it would have in Australia or North America or anywhere else.
Just quickly, Warren, too, just quickly, sorry. There's a couple of gold projects that are being commissioned right at the moment. Watch this space, because it's going to be very, very interesting, I think. We're involved with one of them. But it'll be very interesting just to see how a few of those commissioned. Sorry.
I think the last thing that I think a lot of people don't realize is just really a proper capital structure for these companies. You need to have a management team that's anticipating how to access capital in any part of the commodity cycle, because these are such long-term generational type of projects, from the construction to the operation of it. If you don't have a management team that's not thinking about how to finance this in the lowest, worst market they could possibly imagine, they're not setting it up even up at the top, then you're running into a disaster.
Thank you very much. I think it was a very, very quick half an hour. Guys, thank you very much for your time and your energy. Really appreciate it. Thanks so much. Okay.